Hello everyone and welcome again to my How To Education channel. Just for this week, instead of studying the economics content first, we're gonna do the finance content today. So, How to Ace Finance, Working with Financial Statements, Part 2. On Saturday, we're gonna go over the economics. After watching this video, don't forget to leave me your feedback. I added last week's common size balance sheet to this lecture because we're gonna be needing it to learn about the new ratios. And I also added last week's common size income statement for the same reason. After going over the liquidity ratios and the financial leverage ratios last week, a third type of financial ratios are the turnover ratios, also called asset management ratios. These ratios describe how efficiently the assets of a firm are being used to generate revenue. Turnover ratios are classified as inventory ratios or receivable ratios or asset turnover ratios. Let's take a look at each one now. There are two types of inventory ratios: inventory turnover ratio and days sales in inventory ratio. Inventory turnover ratio equals cost of goods sold over ending inventory. Cost of goods sold equals 523,500. And since the balance sheet given is of 31 December, inventory is the ending inventory. So ending inventory equals 1,345,230. So the inventory turnover ratio equals 523,500 over 1,345,230, which is 0.39. 0.39 is not a good value since it is less than 1. It means that the firm did not sell all of the inventory during the year. If it were 1.5, for example, it would mean that the firm sold its inventory 1.5 times in 1 year. The higher this ratio is, the more efficient the firm is in managing its inventory. Nevertheless, one must make sure that the firm is not running out of stock. Days sales in inventory ratio equals 365 over inventory turnover, which in this case is 365 over 0.39, which is 1014 days. It means that it takes 1014 days, which is almost 3 years, for the firm to sell inventory. A unit of inventory stays in the shop for about 1014 days before being sold. The reason for selling inventory so slowly needs to be investigated, as this is a very bad result. There are two types of receivable ratios: receivable turnover ratio and days sales in receivables. Receivables turnover equals credit sales over account receivable, or just sales if the credit sales are not given, over account receivable. Sales in this case is 750,000. You can check it in the income statement at the beginning of the lecture. And account receivable equals 984,563. So receivables turnover equals 750,000 over 984,563, which is 0.762 times. Again, it is not good to be less than 1, since it means that the firm did not collect all the money that it was supposed to receive from the sales. Let's say that this value is 2. This would mean that 2 times a year the firm collected all its money and made new credit sales. Days sales in receivables equal 365 over receivables turnover, which is 365 over 0.762, which is 479 days. This means that a firm takes on average 479 days to collect the money from a sale made on credit. This is also called the Average Collection Period Ratio, ACP. There are three types of asset turnover ratios: fixed asset turnover ratio, total asset turnover ratio, and net working capital turnover. Fixed assets turnover equals net sales over net fixed assets. Net fixed assets are equal to total fixed assets of the current year minus total fixed assets of the past year plus depreciation. If we're going to analyze the balance sheet of 2008, there is no depreciation, so depreciation in this case is 0. Let's suppose that fixed assets 2007 are 5,187,345. Then the net fixed assets would be the total fixed assets in 2008, which are 5,987,345, minus the one in 2007, 5,187,345. Then net fixed assets equals 800,000. Fixed assets turnover will then be 750,000 over 800,000, which is 0.94. In other words, every $1 that the firm invested in fixed assets made it generate $0.94 in sales revenue. Total asset turnover equals sales over total assets, which is 750,000 over 8,467,138, which is 0.089. In other words, every $1 that the firm invested in assets made it generate $0.089 in sales revenue. Remember that total assets equals current assets plus fixed assets, and current assets equals net working capital plus current liabilities. So total assets equal net working capital plus current liabilities plus fixed assets. These equations will be important for the exercises later on. Net working capital turnover equals sales over net working capital. Of course, we're talking about net sales. So net working capital equals 750,000 over 2,479,793 minus 1,340,807. Net working capital turnover equals 0.65848. Net working capital turnover measures how effective a business is at generating sales for every dollar of working capital put to use. In other words, every $1 that the firm invested in assets made it generate $0.65848 in sales revenue. A fourth type of financial ratios are the profitability ratios. These ratios describe how well a firm uses the available assets and manages its operations. Profitability ratios are classified as profit margin, gross profit margin, operating profit margin, return on equity, which is the ROE, and return on assets, ROA. Profit margin equals net income over net sales. Let's say that net income equals 30,000. Profit margin will be 30,000 over 750,000, which is 0.04. In other words, every $1 that a firm makes from sales revenue gives a $0.04 profit. Remember that profit equals revenues minus expenses. Return on assets equals net income over total assets, which is 30,000 over 8,467,138, which is 0.004. This means that every $1 investment in assets will increase the net income by $0.004. Return on equity equals net income over total equity, which is 30,000 over 2,738,699, which equals 0.011. So every $1 investment in equity will increase the net income by $0.011. Remember that there are many equations for the net income, as for example, sales times profit margin. These equations can help you in the upcoming exercises. When ROA equals ROE, then the equity multiplier equals 1. That's because ROA equals net income over total assets, and ROE equals net income over total equity. So if ROA equals ROE and net income is equal net income, obviously total assets equal total equity. ROE is a very interesting ratio for the shareholders, and its analysis is very important. Gross profit margin equals net sales minus cost of goods sold over net sales, which is 750,000 minus 523,500 over 750,000, which is 0.302. Every $1 in sales will increase the gross profit by $0.302. Operating profit margin equals earnings before interest and tax over sales, which is 50,000 over 750,000, which is $0.067. Every $1 in sales will increase earnings before interest and tax by $0.067. The last type of financial ratios are the market value ratios. Note that we also have the market value measures. Both of these are based on info that's usually not present in the financial statements. Market price and number of shares outstanding are market value measures. Earnings per share, market to book ratio, Tobin's Q, price per earning, price earning growth, and price sales ratio are all market value ratios. Market price is the price at which any product is being sold today. It may be different from its historical value, which is the balance sheet value, also called book value. As mentioned in Chapter 2, the market value is the most important one. Earnings per share equals net income over number of shares outstanding. Number of shares outstanding is a market value measure that describes the number of shares issued and the number of shares purchased by investors. Net income equals 30,000. Assume that there are 3,000 shares outstanding. Then, earnings per share equals 30,000 over 3,000, which is $10 per share. This means that for every $1 invested in shares, net income will increase by $10. Price per earning ratio equals market price per share over earnings per share. This is another very interesting ratio to the shareholders. Assume that the price of one share of stock is $80. Price per earning will then be 80 over 10, which is 8 times. This means that the market price of the stock is 8 times the earnings that it provides. The higher the price per earning ratio, the higher the growth prospects of the firm. Price earning growth ratio equals price per earning over 100 times annual earnings per share growth rate. The lower the price earnings growth, the higher the earnings are increasing. Price sales ratio equals number of outstanding shares times stock price over sales revenue. Note that if the number of outstanding shares is not given, calculate it by doing common stock divided by its par value. Market to book ratio equals market value per share over book value per share. The book value per share equals total equity over number of outstanding shares, which is 2,738,699 over 3,000. Thus, book value per share equals $913. Market value is the current price of one share, which is $80. So, market to book ratio equals 80 over 913, which is 0.0876 times. It is less than 1, which shows that the firm lost value. It is no longer interesting for the shareholders to invest on it. Tobin's Q equals the market value of the assets over the replacement costs. The replacement costs are the current costs of replacing or duplicating these assets. The DuPont identity analyzes ROE as a function of profit margin, total asset turnover, and equity multiplier. So if the ROE, as in the return on equity, is not good enough, the equation will pinpoint the problem. The equation states that ROE equals profit margin times total assets turnover times equity multiplier. Before taking a look at the step-by-step derivation of the DuPont identity, keep in mind that multiplying one side of an equation by 1 yields the same results. Also keep in mind that total assets over total assets is equal to 1, and that sales over sales is also equal to 1. To conclude, we must recap that ratios will not be useful on their own. They need to be compared either to the ratios of another firm, which is called peer group analysis, or to the ratios of the same firm but in the past, time trend analysis. Time trend analysis is usually the most acceptable method of evaluation. This process of comparing is called benchmarking. An example of benchmarking is the Standard Industrial Classification Code, a US government code to classify firms. This is it from finance for this week, but if you have reached the end of this video, it is because the content was helpful to you somehow. If this is the case, don't forget to give your friends and acquaintances the opportunity to have access to these videos by liking, sharing, commenting, and subscribing to this channel. We will be continuing with a lot of exercises tackling all the ratios of this lecture and of the last lecture next week. But before that, I will see you all on Saturday with some economics content. Thank you so much.